Welcome to RenMac Off Script. We're going to discuss markets, economics, policy, history, and life. It's the 21st of June, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account. And if you want to see what we're saying, you can go to YouTube and subscribe to our YouTube account as well to get updated there with some other things. Well, as I say, it's all downhill from here, guys. Yesterday was the summer solstice, so days in the northern hemisphere here are getting shorter. I'm out at this. I would say it's probably best described as that. I think it's Cody Jenks has a song called "The Hippies and the Cowboys," "Raising Hell with the Hippies and the Cowboys." Not really raising hell, but certainly with the hippies and the cowboys. It's a strange crowd. I'm in Telluride for a bluegrass festival, and not a lot of showers happening out here. Speaking of showers, Neil, housing. Little softer. What's going on there?
Yeah, housing's taking a bit of a bath right now.
Thanks for working that in for me. I appreciate that.
Yeah, you're welcome. The data have generally been, softer. So if you look at things like building permits, they're basically running at the lowest levels that we've seen since the middle of 2020, sort of the initial rebound period. And obviously, building permits are a leading indicator for construction. So it suggests that construction activity is likely to soften. I think what's notable is that, up until now, most of the weakness in permits has been coming from the multifamily sector. That part of the market is basically shut down. But now you're beginning to see single family construction weaken. And I think that's notable. I mean, obviously, the sensitivity to mortgage rates, if you look at builder sentiment as well, June data point, we're basically running at the lowest levels for the year. So, across a variety of different economic indicators, it's pretty clear that housing is not going to contribute anything to GDP this year. It probably takes a little bit away from growth. Sorry, not this year, but over the next couple of quarters. And that's a marked departure from where we were over the last couple of quarters. Remember, in the first quarter, residential investment added about 60 basis points to growth. You're not going to get that in either the second or the third quarter, in my opinion. So, that just is a reminder that even though there may have been a lot of enthusiasm for the economy at the turn of the year, we're not going to kind of see the economic performance that we got, in 2023. It's a more, balanced growth picture. Growth is not getting away from the Fed. It looks like you add it all together, we're running at about 2. So some areas are doing a little bit worse, like housing. Maybe you get a little bit more inventory restocking, but it's not an economy that anyone should be getting that excited about. Similarly, consumer spending. I mean, we had a rebound in retail sales in May, but that comes after a much weaker April. So the bounce in May wasn't as strong as you'd expect, given how weak April was. And so, again, I mean, consumer spending, I think it's tracking something close, 2 to 2.5, right? So it's not anything to be especially excited about. So I think, growth is slowing relative to last year. I wouldn't light my hair on fire around a recession or anything like that. I would tend to resist that temptation. But it definitely suggests that, growth is moderating. And if growth is, if the momentum under growth is slowing, it really becomes challenging to see where the upward inflation risk is coming from.
I mean, isn't it a reminder, too, that, policy, as maybe blunt of an instrument as it is, it works. I mean, higher rates have an impact. Did I see something? I mean, am I wrong in this, that permits are at the lowest level of the cycle now? They've dropped to like a crazy low number, right?
I mean, it's not crazy low, but it's the lowest since the middle of 2020. So it's
Right.
basically the lowest for the cycle. And, when you look at basically private domestic demand, so GDP net of inventories, trade, and the government, that's running at about maybe a little over 2% in the second quarter. And again, that's not horrible, but it does represent some moderation from recent quarters. So I think, again, growth isn't getting away from the Fed. If anything, it's been slowing. Inflation, generally speaking, has been slowing. So I just think to the extent the Fed's like a risk management enterprise, I mean, I think the distribution of risks, I think, have shifted. I mean, what's more likely at this point? Like the unemployment rate going up a little bit more or down a little bit? I think it's up, and I think the risks to inflation are skewed to the downside. I've been thinking that for a while, so I just think that over the summer, for me, I think the Fed's rhetoric needs to change pretty quickly, because I do think the inflation numbers will become pretty compelling. And if they don't shift their rhetoric, that's when we can talk about risks building, right? Because I do think part of the market's buoyance right now is probably twofold. Number one, you have a lot of central banks cutting overseas, right? So that's helpful. But also, I think the markets probably assume the Fed steps in and does something before kind of nonlinear risks kick in, right? I mean, because that's always the issue is that, how much unemployment increase are you going to tolerate? And do you do something before that kind of feeds on itself, right? Because unemployment is nonlinear. I mean, if once it goes up, it tends to keep on going up. It never just stops going up half a point. It tends to go up a little bit more. So I think the markets are assuming that the Fed's going to step in the nick of time. I would tend to sympathize with that, but the Fed does have a role to play, and I think that's important. So the Fed's rhetoric, I think right now is in my opinion very offsides relative to the incoming data as I see it. And the hope is that over the month of July, that the rhetoric begins to change relatively quickly.
Yeah, well, from a market perspective, as you say that, the equal weight S&P peaked with momentum, and that was back in April, right? So we haven't made a new high, which is really the real economy, right? The equal weight S&P. Much of this is being driven, by a handful of names. I know that's been a critique of this market for a long time. We haven't been on that train. It's looking more and more like you might want to take a look at that train at least, just because the 20-day highs haven't expanded. This is not a momentum market. The percentage of issues above their 200-day moving average is contracting. So there is that thinness that is resonating with us within that market. I thought interestingly, yesterday, and my associate Kevin Dempter wrote about this in the Daily today. We did have what's known as an outside reversal day in Nvidia yesterday. That's kind of the poster child for all things bull market here and all things about the future. Has a lot of the hype. We've warned against the call activity versus put activity, particularly around that 10-for-1 stock split. It's still there. The excessive optimism is still there. But what's interesting, an outside reversal day is basically a day in which the stock opens higher, opens above the previous day's high, trades higher, and then closes below the previous day's low. In other words, whoever was a buyer that day essentially ended up getting caught at the top of the interim point. Last time we had it was March 8th. That did usher in what proved to be that 20% correction consolidation. We'll see. But certainly you get these outside reversal days with those sentiment extremes. That's your price and your sentiment confirmation, right? You can have sentiment that just kind of flies in your face, and that's what's been happening over the last couple of weeks with Nvidia. And then you get that price confirmation, and that's where we look at the yellow flags turning a little bit more amber in our world than not. Interestingly enough, the work that we're doing around yields, and it's curious, and it's always the challenge with data, always the challenge in our business. It feels like, and I know people want it to be so simple in the data, but you really have to tear it apart and understand the regimes in which you're operating. And the reason I say that is because if you look at something like banks have a historically terrible and statistically significant negative relationship with yields. What does that mean? As yields go down, the banks actually tend to go down. I'm sure it's a positive relationship, right? As banks go down, yields go down, the banks go down. And what we've seen in that is, particularly since the advent of quantitative easing and quantitative tightening, has that been the case? If you take that data back pre GFC, or really 2011, there's really not much of a relationship there statistically between what the performance of the 10-year yield is and what the sensitivity is to banks. And so, a question that is always kind of looming for us and should be for everyone is the data today going to continue to be representative of the most recent history, or is the data today going to be representative of the entire history? And that's where it really becomes kind of an artful, skillful process. And so, what's interesting is the T stat is declining rapidly between the 10-year yield and the banks. In other words, that relationship, while it still might be positive, is really a lot more positive from 3 years ago than it is today. And so, as we look at that, it sort of says, okay, this oversold condition clearly is a reflection of these yields coming down. Will we get a bounce? And if we get a bounce, we're going to really need yields to go up to do that from the oversold condition. I think either way, European banks are oversold enough and in strong enough trends that they're probably in a pretty good spot. The other interesting part about that, and this is where the T stat, the significance of that relationship is actually increasing, is with REITs. The big beneficiary of REITs, or sorry, of contracting 10-year yields, is REITs. And so we haven't seen that change yet on a relative basis, but certainly, if we're looking around corners, if we're going to continue to have a downward trajectory for the 10-year yield, and we haven't officially broken that trend yet, but if we're on the verge of transitioning that trend, then REITs should be big beneficiaries of that. So we'll continue to watch it. Either way, the good news is materials are oversold. They've responded decently, and we still think that materials are a pretty good place to be. Um, Steve, I think next week probably the big thing is this debate. I mean, it really is pretty interesting because I think there's so much at stake for both sides, and one has pure entertainment value, and one is kind of like watching NASCAR. I mean, you don't want to see people wreck, but it's kind of exciting to see it, particularly when they walk away all right. But I mean, the Biden strategy does not seem to be on the table. They put them out there, I guess, good or bad. I mean, I saw the clips of the Hollywood fundraiser. I don't know how much that was, edited out or for real. But what's the latest? Go ahead, Neil. I know you got something to say.
I
Throw it
think
out
it's
there.
hysterical how the fundraiser hosted Jimmy Kimmel, who's a media personality for ABC. And is ABC hosting any debates? I
The
mean,
second debate.
oh, well, no, that's totally fine.
Yeah.
Totally fine. But I mean, it's a good thing Trump agreed to it, but I think it's, again, I mean, it's kind of funny.
How is Jimmy Kimmel even relevant? He's
I
not
think I
funny.
speak for
He's a
most.
sycophant. He
I
went
think
to
I think I
ASU.
speak for most of us when I say we all preferred him when he was on the Man Show.
Yeah.
The steady decline ever since.
Yeah. Oh, good.
Well, just quickly on it was interesting that the White House is using the term cheap fakes, which is separate from deep fakes. Deep fakes provides some alteration of a video. Cheap fakes is undefined and suggests just more an unflattering video that is not helping with their candidate's biggest political liability. But looking at Thursday's debate, I think at this point, the burden is on Biden to change the trajectory of the race. I mean, you have, polls showing Trump in the best poll position he's ever been in. Now, Democrats may take issue with some of that. If you want more detail on that, stay on the lookout for Sunday's piece that's going to delve into sort of Biden's bull case. But right now, the pressure is on Biden to go ahead and change the trajectory of this race. I think Neil makes an interesting point in that, look at the debate conditions. Trump, by sort of making an issue of anytime, anywhere, any place, didn't leave him a lot of negotiating leverage. So the Biden campaign has been able to dictate the terms of this debate to ones that are extremely favorable to him. They've gotten everything that they've wanted, including a very favorable network in CNN with two very, very favorable moderators in Jake Tapper and Dana Bash. Moderators is an interesting term because they are well-known Trump critics. Now, they're actually going to be in a very interesting role, in my opinion, because they're going to feel a lot of pressure from their progressive peers in the media to sort of prosecute Trump. But if they go too far in that, then I think they actually risk making Trump more of a sympathetic figure, where everybody just starts, look, they're sort of piling on here and bullying him.
100%.
Trump did that with the second debate against Hillary Clinton. So sort of damned if you do, damned if you don't. And I think the thing to keep an eye to, just the perspective, what are we going to see after the debate? You know, polls suggest that these general election debates don't move many voters. And I think the rationale behind that is that most people tuning in are politically engaged. They walk away with just reaffirmed opinions. I think it's really going to be the coverage of the debates, whether subconsciously or not, that may trickle down to those few persuadable voters that are ultimately going to determine the election. There is always a risk that Biden goes out there and has a very senior moment, similar to what we saw Senate Republican leader Mitch McConnell have when he just publicly froze into press conferences. His team didn't think that was going to happen. It's a possibility. I'm not saying it's a probability. If something like that happens, then I think you really see more of a push behind the scenes for Democrats to dump Biden at the August convention. Even just playing to a draw at this point, I don't know that that benefits Biden because, again, the trajectory of the race isn't going his way. Now, Biden does benefit, from a positive debate performance. And look, the key to happiness is low expectations. Nobody should be happier than Biden because basically he just comes there, formulates some relatively coherent sentences, and doesn't have a senior moment. Then, potentially he could benefit from that. And if he does, then I suspect that will be the first and only debate that we see. Because look, the odds of his condition improving between now and September, why take that risk? Second debate might also coincide with his son's tax evasion charges. So again, that's sort of how I'm looking, some things to keep an eye on here. In terms of issues, I'd be surprised if we hear much discussion about that. I think it's really going to focus more on insults. Look, from Biden's perspective, when you get into issues, the economy and immigration, polls show those aren't going your way. And I think even on abortion, which is an issue that is pulling better in the direction of Biden, he sort of runs the risk of Trump baiting him into, do you support abortions up to birth? And I don't know that a more agile politician would be able to really thread that needle. And we talked about Biden's condition. He's not in his prime. So I think he's really going to focus on Trump's conviction. Trump will probably bring up Hunter's conviction, and we'll see where that sort of plays out. But I think that's probably, honestly, the level of content you're probably looking at more as opposed to a substantive debate.
Yeah, just friction, friction, friction. They have to have a plan if he has a senior moment. Like, what do you do? And actually, part of that might be, what does the network do? Does the network continue to cover him, or do they back away? Because, if the shoe were on the other foot, I'm not sure that they would do. I mean, remember Mike Pence and the fly on his,
Yeah, no,
on his
and,
hair?
and
They
now
were
they zoomed in
happy
on
to
it.
keep that on there, right?
There are two commercial breaks, which are probably buyer breaks, given the age of both candidates. Let's be candid about that. And there is a delay. So, there will be some question of that. There's an interesting debate going on amongst Democrats right now as to the
Why is there a
ability.
delay? They worried about the F-bomb? What, like, what?
Well,
What's
with Trump, I guess that's always a risk. But, in terms of the ability to mute Trump's mic, there's sort of a debate amongst Democrats whether or not that's beneficial or not. I mean, one of the takeaways from the last time they debated 4 years ago was sort of Biden's kind of shut up, man, let me finish. You're not going to get that now. And so there's some people that believe that it's good for Biden that Trump, will be muted. Others believe, look, you should let him talk, that might actually benefit Biden. So, that seems to be an interesting debate to watch now amongst Democrats.
So are they on a time? I didn't know that. So they're on a timer, like the Supreme Court. When you make your case, you get your three
Sort of.
minutes.
Yeah,
Yeah.
I mean, the format, there's not going to be any opening statements. There's going to be questions presented, followed by a 2-minute limit to articulate position and sound bites, and then the opportunities for rebuttals, but there's some discretion there. Again, that discretion is at the moderator's decision, which gets back to what are the interests here of the moderators. So something to keep an eye on there.
Do you ever watch that show Robot Wars or whatever it was, where you put your two in like the gladiator ring? It's like MIT against Georgia Tech, and you put your robots in, and then they go to the death. They should do
I
that with
can't
these
say I
two.
watched them, but I'm familiar with what you're talking
They're pretty
about.
good. I mean, they should do that with these two with a wheelchair and just be like, here we go. Like, let's put them in the gladiator ring and let's see what happens. Well, that's that will definitely be on at my household just for pure entertainment value, unless the Stanley Cup goes that late. But I don't think it goes till Thursday. We'll see. Neil, what's on the docket next week for data?
Well, there's a lot of information coming out next week. I'll be, again, keeping an eye on the housing market. We'll get data on pending and new home sales. We watch that because in both cases, those represent signed contracts. So pending home sales are signed contracts on existing homes, and new home sales are signed contracts as well. But contract is signed, so that's a leading indicator for closings and therefore broader economic and housing activity. We also get the consumer confidence data. This is from the Conference Board. We're keeping a close eye on that only because, generally speaking, over the month of June, and this would be a June data point, we've seen the stock market's been okay. I mean, it's generally been going up this month, and gas prices have generally been going down. And so if you get a big slowing in confidence or a big decline in confidence, I mean, that would kind of put a lot of focus and attention on the labor markets, right? Because what else could explain the weakness in consumer confidence, at least on a month-to-month basis. So, we're going to keep an eye on the labor differential because the Conference Board data typically, historically has been thought to be more sensitive to labor market conditions. And then we end the week with the core PCE price deflator, and we're looking for 0.1%. I think it's going to be a soft 0.1%. But it should put more momentum behind this disinflation story. Of course, we've known this was coming. I mean, based on the CPI and producer price index data. We'll also be getting some Fed speak. I think next week we get Governor Waller. He's giving opening remarks at some banking conference. But anyway, I mean, Waller is an interesting one to listen to. We'll see if he says anything about the economic and monetary policy outlook. But as I said, I mean, I'm watching Fed speak because I think right now the Fed speak is offsides generally relative to the data that's coming in. And the more offsides that becomes, I think the more unhappy the markets might get.
Yep. Well, let's watch the 10-year yield, above 430, and we start to transition that higher. We expect, or certainly are more apt to be willing to see the 10-year yield move lower and stabilize somewhere around 4, maybe 3.75%. In terms of the overall market, I think breadth is going to be important. We need to get the number of issues above the 200-day to expand. That will give some longevity to this market. I do think this Nvidia outside reversal day is important, partly because seasonality for semiconductors specifically starts to turn negative in July. So, we're kind of right at the point that should start to happen. So, Nvidia, we don't usually watch one stock as a tell, but I do think there's going to be something to Nvidia's ability to fight through this outside reversal day. And, frankly, I think that's a longer putt. I'd say 2 or 3 odds are that we put in a tactical top there for Nvidia. On the other side, we're going to want to continue to see, in terms of the overall health of the economy, particularly the European banks perform off of the oversold condition, and materials perform off of their oversold conditions. If you can't respond to an oversold condition in trend, you're starting to lose that trend. So we'll watch those very, very carefully here as we go. And I'm not even going to ask Steve because I know what he's going to say about next week. No offense, Steve, but we'll keep it tight for.
Well, I actually one thing to keep
always
in
the
mind.
last word with you politicians.
Well, that's sort of related to this. We're still expected to get several Supreme Court decisions. Usually they have to do that by the end of the month. And I mention that is because we're taping this Friday morning. We're still waiting on 2 decisions actually involving Donald Trump and some of his legal concerns. So I'm curious whether or not the court decides to reveal those ahead of Thursday's debate or wait and dump that on Friday. So stay tuned for that.
Interesting, right? Very good point. Well, join us again next week. We'll be 1 week older, 1 week wiser. Probably bags under our eyes from the debate Thursday night. Don't forget to follow us on Twitter. And if you want deeper insights, go to RenMacAccess.com or see us on the YouTube page. Search for RenMac and you'll see us. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.